All right, let's jump right into this explainer because I know you've seen them. Those loud, absolutely viral headlines popping up all over your feeds, screaming about the total, imminent collapse of the US dollar. It feels like every few months, right? There's this massive new wave of panic, or maybe excitement for some, claiming that the dollar's days at the very center of the global economy are completely over. But are they really? Well, that brings us to the absolute core of what we're investigating today. Are we literally watching the destruction of the US dollar's dominance, or is the world just kind of building new alternatives while still relying heavily on the dollar itself? Now, this matters immensely. We're talking about something that affects everything from global borrowing costs to the price of commodities and even everyday cross-border business. So to find the real truth, we're not relying on rumors. We're looking at hard, verifiable data straight from the IMF, the Bank for International Settlements, and the Federal Reserve.
Dollar collapse, BRICS expanding, central banks hoarding gold. Seriously, we've all seen these alerts, and man, they sound so incredibly dramatic. But today, we're going to look right past all that sensationalized noise. We want to uncover the nuanced, completely impartial reality of what is actually happening in the global economy right now. Zero spin, just the facts.
So let's get into it. Section 1, the dollar collapse myth. Time to separate fact from fiction.
Moving on to Section 2, designing de-dollarization. Let's get really precise with our terms here.
Because to truly grasp what the data is telling us, we have to know exactly what we're talking about. People throw around this word de-dollarization to mean, well, wildly different things. But generally, de-dollarization refers to the reduction of the US dollar's dominance across a few very distinct categories: foreign exchange reserves, trade invoicing, global debt, and cross-border payments. The absolutely crucial takeaway here: this isn't just one giant monolithic thing. Look, a country might decide to settle its trade in Chinese yuan just to save on exchange fees, but, and this is a big but, they might simultaneously keep all their national savings safely parked in US dollars. These things are not interchangeable.
And this perfectly highlights the three distinct jobs a dominant international currency must perform, and perform flawlessly, to hold on to its throne. First, it has to be a rock-solid store of value that central banks actually want to hold. Second, it needs to be a seamless medium of exchange that everyone accepts for payments. And third, it must serve as a reliable unit of account for pricing global stuff, like commodities and contracts. Think about it like a giant puzzle. To actually replace the dollar, a competitor has to have liquid markets, trusted institutions, and open capital flows to do all three of these jobs at the exact same time. It's a really tall order.
All right, Section 3, the hidden data reality. Let's look beyond those flashy headlines. Okay, let's dive into the actual numbers, because the data reveals a super fascinating hidden reality that those panic-inducing headlines completely miss. We'll start with the most famous stat in this whole debate. Yes, it is true that the dollar's share of foreign exchange reserves fell from a peak of around 72% back in 2001 down to 57.13% by the first quarter of 2026. Now, if you only look at that one specific metric, it kind of looks like a slow, steady bleed out. But here's a little context. Q1 of 2026 actually saw a quarterly increase from the quarter before. Plus, a lot of this historical drop hasn't been a massive stampede toward one single rival. Actually, it's mostly been diversification into a basket of much smaller currencies. But hold on, because here is the massive twist. Foreign exchange trading, it tells a completely different story. As of April 2025, data from the Bank for International Settlements showed the dollar was still involved in an absolutely untouchable 89% of all global currency trades. Now, quick side note, because every single currency trade involves two currencies, the total adds up to 200%. But just look at the nearest competitors. The euro was in just 29% of trades, and the renminbi only 9%. Why? Because the dollar is essentially the world's universal vehicle currency. It is almost always vastly faster and cheaper to trade from your local currency into dollars, and then from dollars into the target currency, simply because the dollar markets are so much deeper. Now, what's genuinely fascinating here is how incredibly entrenched the dollar is in the literal plumbing of global banking and international debt. We're talking roughly 55% of all international banking claims, 60% of banking liabilities, and about 60% of foreign currency debt issuance, all completely dollar-denominated. This creates this incredibly sticky network effect. Think about it. If a foreign company owes a huge debt in dollars, they constantly need dollar revenues to pay that debt back. Ironically, during times of global financial stress, this actually spikes the demand for dollars because borrowers are just scrambling to get the cash they need to meet their obligations.
Which brings us to Section 4,
Gold and the BRICS factor. Let's look at the alternative drivers. So let's pivot to the two biggest buzzwords you constantly see in the de-dollarization debate. First up, gold. We keep hearing that central banks are just dumping dollars to hoard massive, unprecedented amounts of physical gold. But this data right here perfectly captures what experts call the valuation illusion. Check this out. A 2025 Federal Reserve analysis found that since 2015, the market value share of gold in official reserves shot up by over 100%. Wow, right? But the actual physical quantity of gold they held, that only went up by less than 10%. Meaning, central banks aren't necessarily piling up massive new mountains of gold bars. The gold they already had just skyrocketed in price. And while gold is a fantastic store of value, you can't exactly use it to settle everyday credit or modern trade. And then, of course, there's the BRICS nations. Now, it is totally true that BRICS countries are successfully increasing their bilateral local currency trade. They want to reduce their exposure to sanctions and dollar volatility, which makes total sense. But, and this is a big but, there is absolutely no functioning unified BRICS currency anywhere in sight. Actually, in 2025, Brazil pretty much shifted its focus completely away from a near-term common currency and decided to just emphasize local currency payments instead. Creating a shared currency is insanely complicated, especially when trade is unbalanced. I mean, if you export way more to a partner than you import, you just end up stuck holding a massive pile of their currency that you can't really spend anywhere else. Historically, the universally accepted US dollar solved exactly that headache.
Next up, Section 5, Euro and Yuan limits. Let's talk about structural constraints. So if a BRICS currency isn't happening right now, what about the alternatives we already have? Well, when we put them side by side, we see some major structural roadblocks keeping the dollar's two closest competitors, the euro and the yuan, away from the crown. The euro is by far the strongest alternative. It holds about 20% of global reserves. But Europe desperately lacks a unified, massive debt market. Yeah, they've done some joint borrowing, but that's $700 billion of joint EU debt in 2025. It's basically a drop in the bucket compared to the more than $28 trillion in U.S. Treasury securities. Investors need a massive, deep pool of safe assets. On the other side, you have China, an absolute exporting powerhouse for sure. But the renminbi's global adoption is severely bottlenecked by strict capital controls and limited convertibility. Honestly, global investors are just going to hesitate if they aren't absolutely guaranteed they can move their money in and out freely.
Let's zoom out for a second and take a wider historical view to see how this all stacks up. From the very beginning of the Bretton Woods system way back in 1944, right through the launch of the euro in 1999, to all the intense sanctions and geopolitical shifts in 2022, all the way to the first quarter of 2026, where the dollar's reserve share sits at 57.13%. When you look at it like this, the takeaway is clear. Despite decades of totally genuine challenges, massively shifting global power dynamics, and the explosive rise of new economies, the dollar's institutional network effect remains incredibly, almost historically, sticky.
All right, Section 6, the digital dollar paradox. Let's talk about stablecoins and U.S. debt. Because, you guys, the most surprising plot twist of this entire explainer might actually be happening right now. And it's not happening in central banks. It's happening in the digital realm. By April 2026, data from the Federal Reserve revealed that the market capitalization of stablecoins, those digital tokens pegged to stable assets, absolutely exploded past $300 billion. And here is the kicker. This market is overwhelmingly, almost entirely, concentrated in dollar-linked tokens.
So the crazy paradox here is that instead of some new digital currency swooping in and replacing the traditional dollar, these crypto networks might actually be supercharging it. They're allowing people all over the world, especially in countries battling highly unstable local currencies, to hold and transfer digital US dollars without ever needing a traditional US bank account. It's a real game changer. But it gets better. To back all those digital tokens, the companies issuing these stablecoins have to buy up massive, massive amounts of short-term US Treasury bills. So ironically enough, cutting-edge digital technology is literally driving massive global demand for traditional US debt. The Fed even hosted a whole conference in June 2026 just to figure out how tokenized assets might expand the dollar's global reach even further.
So, what does this all mean for us? Well, the most defensible conclusion we can draw from all this data is this.
The world is diversifying, sure, but mostly just at the edges. The dollar absolutely has not lost the throne. Yes, governments are test driving alternative payment rails, they're buying up gold, and they're definitely pushing for more local currency trades. We're slowly inching toward a more multipolar system. But right now, no single alternative on the planet even comes close to matching the dollar's unique superpower combo of immense liquidity, full convertibility, a deeply trusted financial infrastructure, and just an endless supply of investable, safe assets.
As we continue to watch this slow, massive evolution unfold, I really want to leave you with one final thing to ponder. If a true, viable alternative to the dollar actually does emerge someday, and we shift away from having one single dominant currency, would a decentralized, multipolar financial world actually be safer and more resilient? Or would it just make international trade wildly more fragmented, incredibly expensive, and just a massive headache for everyone involved? Something to think about, right? Thank you so much for exploring the data with me today on This Explainer. Remember to always question the headlines, stay curious, and I'll catch you next time.